All right, let's get started. So I put out there, getting ready for the final exam, gave y'all a couple of questions. I won't ask y'all today because I doubt anyone with paper 2 coming up. The next Monday, I'll ask for volunteers to work through these problems. Good practice problems, just like on the exam. The first one's a bond valuation. You already know this from previous classes, so this is a refresh. But you have to do it the way I said to set it up. I'm real picky. This isn't about Excel or calculators. It's about knowing what a bond actually is and making sure you understand the math behind it. So that's a good practice problem. And then good basic calculations of return, arithmetic, geometric averages. We use a lot in finance. So something you need to just become second nature. So after you get paper 2 done, work on these problems and volunteer next Monday, and we'll work them. I forget how many problems. I think there's 7 problems on the exam, so there's 2 of them right there. So you're almost, close to over a fourth of the exam just by doing those 2. And then I mentioned the JP Morgan analysis. So it's very dated. It's over a decade old. It's still timely as far as the processes they use. But look how they titled this thing, the most important number in finance. And the market risk premium, also known as the equity risk premium. So I emailed all 5 of these people, and I think 3 of them had stopped working for the company. So only one of them sent back, but they said that I could send this to y'all, even though it says you can't copyright it. So it's a good discussion. And then they talk about the different approaches. You can see the range that they're getting. So the implied from bonds, we talked about, there's other approaches besides the historical and implied. This is not the implied we're using. This is implied from corporate bond spreads. The historical, academic studies, I don't know if anybody uses academic studies because all they're going to do is essentially do these other approaches. And so academic studies, they give you a range there. These other ones they call dividend discount model, dividend yield methodology. The dividend yield methodology actually is the implied approach. So that's the one we're going to actually use. They got 6.6. We'll see if we get that much. But they say the market risk premium can range anywhere from 5 to 7%. There are other people out there. Damodaran, market risk premium, and he publishes all of his stuff. And he actually provides it for free, which is kind of cool. But here's his market risk premium. Here's the risk-free rate down here. And here's the market risk premium. So the sum of the 2 together is what you expect stocks to return. It's a required return on stocks, the sum of the 2 together. He uses the historical, the implied approach as well. The implied approach is pretty important. The market risk premium itself, you notice, doesn't change all that much. What's moving around is the risk-free rate. But you take the risk-free rate plus the market risk premium, that's what stocks are expected to return. So he uses that expected return. Is the expected return also the required return? Well, if markets are efficient, they should be the exact same number. And so he has a fairly constant market risk premium over time. He doesn't shift it that much. And you can see his risk-free rate getting down to that 0.5 last year, getting pretty low. So that's his approach. Look at all the stuff he has for free. That's pretty. It's value in Tesla. He has all kinds of stuff out there for free. So it's a great resource as well. So if you look at what we got to last week, we decided to go with a 2.4% risk premium. Why? Because that's where the 10-year is right now, and it's where the forward curve is as well. So right now the yield curve is so flat, the current 10-year and the expected 10-year are about the same. So there's not much adjustment to do there. I still recommend you learn how to do the forward curve. Of course, boy, it's a powerful thing to know how to do. So right now we're working on the market risk premium. Again, if you go back to JP Morgan, they actually show you the risk premiums over time and how they change. And then they go over each one and even give you ranges over time. The constant Sharpe ratio method, I had a boss that did that. I don't know the bond, I don't know exactly their math behind here, but it's just what they're saying. If bond spreads gap out, risk premiums should be gapping out, because if we're more worried about bonds going to default, we obviously must be worried about the economy and stocks. So there's some logic there. And then a dividend yield model is essentially the dividend yield plus the growth rate. Isn't that what I said is the implied approach? That's what we expect stocks to make, right? The dividend yield plus the growth rate. And so that's the approach that we're going to use. They have the survey approach. I think they use the VIX, but I don't see the VIX in here, but I think they have the VIX approach in here as well. So very, very important number in finance. Oh, sorry. So the implied approach says the expected return on stocks should equal the required return on stocks. So what we're looking for is a required return on stocks. So let's step back. Required return on stocks, we usually call that KE equals the required return on stocks. It's the return needed to compensate for risk. We're going to use the capital asset pricing model, but the capital asset pricing model tells you it's the risk-free rate plus beta times the market risk premium. You should have had this in a previous class. So we just got the risk-free rate at 2.4%. We're trying to get, we already did the beta too, right? We can do a pretty good job of covering beta. So now we just need the market risk premium. So what is the market risk premium? Is that that's how much you need the average investor risk premium needed to invest in stocks in general, not in any particular stock, but in stocks in general. So it's a premium. You can think about it. It's someone's going to buy the S&P 500 stock index fund. How much over 10-year treasuries does the stock market need to be providing so that you're willing to take that risk? All right. Why in the world does JP Morgan say that's the most important number in finance? And why does Warren Buffett say it's the most important number in investing? Why do other people call it the most important number? Because it drives so many things. It especially drives people's stock and bond allocation, but it's an extremely important number. But the problem is we can't go get that anywhere. It doesn't exist. There's nowhere to go look it up. So we have to figure it out. So they're giving you all these approaches that you can figure it out. So they said one approach, well, let's just go out and ask a bunch of professors what their market risk premium is. So that's a bunch of academic numbers. How trustworthy is that? Who knows? What's the downside of investment finance professors? They don't have much skin in the game. If they're wrong, what happens? Nothing. They're tenured. Who cares? Right? So there's not much skin in the game there. We could look historically. Historically says take the return on stocks in the past minus the risk-free rate. So the historical approach, which is what I grew up on, which is what most of us did in the 80s and 90s, just said, hey, what did the stock market give us over treasuries in the past? Let's just assume that's what they'll give us in the future. So that's the historical approach. And then the implied approach came along, and the implied approach said, you know what? The return we got in the past might not have been what we required. We might have required 8%, but we were surprised and got 10%. So we were really, really happy. So if we use history, we might have a risk premium that's too high because we just come through some really, really great times. You know, the US has been a really great stock market back the last 50, 60 years. Is that really what stockholders are required to cover for risk, or is they just got some really, really good returns? They're very, very fortunate. And if they were just fortunate, if there were surprises, then using history is going to overstate that risk premium and will be charging too much for risk. But that's the argument with the historical approach. Dr. Ibbotson, who's the famous one for this, he goes back to 1922. Anytime you see 1922 on stock returns, that's coming from Dr. Ibbotson. His argument, if you have enough time, then kind of all the good times and bad times will offset each other. But we're still talking about the U.S. stock market, which, the U.S. has been, other than maybe Australia, has been the one country that's been fairly fortunate the last 70, 80 years. Even with World War II, other than Pearl Harbor, we didn't see much activity on our soils. So let's talk about the implied approach is what I want you to use from paper 3. The implied says we're looking for the required return on stocks. That doesn't exist anywhere, but we can figure out what stocks are expected to return. And let's just assume those two numbers are the same. Because if they weren't the same, if the required return was higher than the expected return, the stock market would sell off. Because if you require 10% return, you think stocks are going to give you 8, you're going to sell all your stocks, stock market will fall. If the stock market crashes, then your expected return goes up, right? Because you get to buy stocks at a cheaper price. If the required return is lower than what you expect, then everybody's going to buy stocks. They need 8%, but they're expecting 10. They're going to buy stocks. Stock prices rise. Expected return comes down. It has some logic to it that the markets are efficient, and it makes a lot of sense. And we've already talked about the expected return on stocks. It just equals the dividend yield plus expected earnings growth. So if we can just figure those two out, and I showed you all charts on that, right? Didn't I? Oh yeah. I get this class mixed up with my other class. I think I showed you charts on that, but if not, I'll show you charts again. We did charts right at the beginning part of the class, didn't we? I think it's even in the class notes if I can find them. I don't know how far back I got to go. It's during the stock discussion. These stocks back here, these charts back here. Anybody remember that chart? It's been several weeks. What did I do with this chart? I went back to 1871. Anytime you say 1871, you think Schiller. This is Schiller's data. So you go back to 1871, and I just did every decade's dividend yield plus earnings growth. And I put on top of that the blue line, which is the actual stock market. We talked about how that actually was a pretty good estimate until just recently, where the stock market looks somewhat expensive. And then we talked about how corporate earnings grow pretty much in line with the economy. Corporate earnings have grown about 6%. Our economy's grown about 6.4%. So you should expect corporate earnings to grow about the same speed as the U.S. economy. So we've already covered this before. So we just got to figure out these numbers. So the expected return on stocks is the dividend yield. What's the current dividend yield? So for paper 3, where do you get the dividend yield? You can go into Yahoo Finance and you just type SPY. SPY is an exchange traded fund of the S&P 500. And whatever its dividend yield is the dividend yield for the market. There it is right there, 1.3%. Does that sound high or low? Sounds kind of low to me from my career. If you look back historically, here's the dividend yield historically. Oops, let me enable. Boy, this transcript thing is fine, but it's running away. I don't know why it did that, but let's see if it will do it correctly this time. So here's the dividend yield. Here's where we are today. This is where we've been historically. I can put some years in there if you'd like. So we used to be up in the 3s or so range. We got down with the dot-com bust. Remember that? Dividend yields got really low. 2008, they jumped up, not because firms were paying more dividends, but because stock prices fell, right? The dividend yield is dividends over stock prices. So when the market crashed, dividend yields jumped up to 3.5%. They're now back low. When's the last time they were this low? Right before the dot-com crash. Is that a good sign or is that a bad sign? Kind of scary, isn't it? Anybody remember what's different today that wasn't true back then? What are firms doing today they weren't doing back then, 20 years ago? Besides paying dividends? What's the big change today? How else can firms distribute earnings? Pay dividends? And repay debt, or what else can they do? I've talked about rebuying stocks, buying back their stocks, right? So historically, companies have actually issued more stocks than they purchased back, except for the last 10 years. The last 10 years, firms are actually buying more stock back than they're paying in dividends. So that might be our salvation here. I'll give you all a paper that you can use for that, but the buyback yield, that's how much firms are distributing by buying their own stock back. That's a lot like a dividend yield, but it just comes up, it doesn't quite reflect in the numbers. I'm just going to say that's 1%, but who knows what that really is. I'll show you the paper, but the paper I have is a few years old. So I'll get you that paper eventually. It has a chart in there when it shows the numbers. It does have a really cool chart where they show dividend yields coming down and buyback yields going up, and they actually cross. So the buyback yield actually go above the dividend yield. So this might be our salvation, because back in 2008 with the back in 2001 with the dot-com crash, firms were not buying their stock back. They were issuing more stock than they were buying back, and so that brought it down. And then expected earnings. Remember, expected earnings is going to equal, it's going to be a function of economic growth. And what are the three pieces there? Anybody remember? Productivity, does sound familiar? Productivity, growth, plus labor growth, plus inflation. That sound familiar? That's how our economy grows. I'm ignoring exports and imports. They're important, but they're a pretty small percentage. We know that subtracts a little bit from this number. So on paper 3 and paper 4, you're going to use this number of the stock market's going to be tied to dividend yield plus expected earnings growth. The expected earnings growth is going to be closely tied to economic growth. Economic growth is going to be productivity, labor, and inflation. And so then we have this chart that we used early in the semester, which showed you those components of economic growth back to whatever year that was, back to the 50s. And productivity has been ranging anywhere from 1.5% to 2.5%, maybe up to 3%. The median's 2%. What do you expect productivity to be going forward? That's kind of a massive question. Again, that's what President Obama wrote in his last article to The Economist in his last month in office, was why is productivity so low in the United States? And you can see it was very, very weak, not just in the United States, but all over the place. People are asking this question. Some people are actually asking the question, is it that we're calculating productivity incorrectly? I think I gave y'all my theory. My theory is we used to be manufacturing, now we're more service. Service is a lot less productive than manufacturing. I forget the numbers on the steel industry, but I saw some really incredible numbers. How many people it takes to produce a ton of steel today versus 50 years ago. And it's phenomenal how much more efficient we've gotten in manufacturing. Manufacturing is just getting rid of people all over the place, right? They're doing more and more things with robotics, more stuff they can do, you know, with machinery and all that. The service industry and the two worst service industries, you may remember those, the two most unproductive industries in the world. Anybody remember? Healthcare, and you're sitting in one of them. Education, terribly inefficient. It's either one of them going to be disrupted. I hope they're both radically disrupted. I love seeing Costco getting into healthcare. I love seeing Apple and Google getting into healthcare. Healthcare is incredibly wasteful. If you take my life insurance class, we talk about how Medicare wastes anywhere from 30 to 50% of what Medicare pays for is completely wasted money. It doesn't improve anyone's health. That's trillions of dollars are thrown away for no reason. Very inefficient. We're giving people knee surgeries when we know knee surgery is less effective than rehabilitation. Why? Because you know what? You know, have you heard the phrase, don't ask a barber if you need a haircut? Have you ever heard that before? You can say the same thing about a surgeon. Don't ask a surgeon if you need surgery, because what are they going to do? They're going to cut you open, all right? So our healthcare has really, really bad incentives. So those are my two real keys, healthcare especially. If healthcare is disrupted, I'd actually think we could see some pretty decent productivity in the United States. Education, we'll just see. There's some bad incentives in education as well. However, COVID is radically changing education as well. So we'll see what happens with these two industries. We also have artificial intelligence, robotics, all these other things are coming along. So we'll see what all those have an impact on our productivity. As we mentioned earlier in the class, those all sound wonderful and dramatic, but are they as dramatic as the United States getting electricity, or getting cars, or getting planes? You know, are we seeing the best productivity ever seen? No, probably that was back in the 20s and 30s. That's when productivity just completely, you just went wild. And China, I still think, is publishing 5% and 6% productivity numbers as they move more and more of their economy from the country into the cities. But how long can they keep that going? Eventually, you've done as much moving as you can, right? You've got everybody in the cities that you can get. They're as productive as they can be. So what's China's big thing? Artificial intelligence. Is that going to save them and bring a lot, you know, so who knows? You've got to figure that out. I don't have to figure that out because I'm retired. So I'm fine. You've got to figure that out because these are the assumptions you're making about the US stock market. And it is all tied to US economy. If the US economy productivity drops to 1%, it's going to be a horrible stock market. If it gets up to 3%, it's going to be, and productivity really is the key. The key to all wealth and all gains in the world is productivity. You got to get productivity to get wealth and get stock markets to rise. So you might spend a little bit of time on that in your paper, but we know historically, whoever at Zoom decided, what did I just do here? Am I still sharing? Am I still sharing? No? What did I do? All right, Zoom. Was it sharing before? Yeah, I don't want this thing to show, but you know what they have to get rid of this, to bring the floating back, is the escape key. How do you get out of screen show in PowerPoint? It's the escape key. So they should not have picked the escape key, whatever they could have picked any key but the escape key. All right, so productivity historically, 2% has been a pretty good number. What would you argue in your paper? If you want to go above 3, boy, you better have a few paragraphs on why you think it's going to be above 3. We've never had a decade in our history above 3, ever. There's 3%. We've never gotten to 3%. So 3% would be our very aggressive number for productivity. And that's even us coming out of World War II with, all these people going to college for the first time and all this other stuff, incredible productivity gains. So I would think 1.5 to 3% might be your range. 1.5 would be pretty disastrous. That's what President Obama experienced during his presidency, is what UK was experiencing. A lot of people are confused. How can we have such low productivity with the internet and all this other stuff going on, but pretty low productivity? Labor growth, we're not having as many babies as we used to. Some countries like Japan more people are dying than are being born. President Abe tried to get people to have more babies. It's kind of tough. How do you get people to have more babies? Childcare, you give them tax credits. In my opinion, a baby is a lot of work. Give me a $500 tax credit. You better give me a $5 million tax credit. You can have a baby, because that's a lot of work. It's a lot of pain, a lot of lost sleep. So giving people a little bit more money, it's probably not going to incentivize them to have more babies. And it's just tough. They can't get people to have more babies. It's true around the entire world. As countries get wealthier, their birth rate comes down. There are still countries that are growing in populations. And so the key is then going to be immigration. Can we get those people into the United States and work for us? That's what's Japan doing? They're using robots. Japan is the king of robots in the world, and they've used them quite effectively. But that's productivity, right? So is there a battle between the two? If productivity takes off, does that mean labor growth is really weak? So you've got to figure that out. I can't imagine going much above 1%, because the baby boomers are retiring. I'm the end of the baby boomers. All of my friends at UTSA are either retiring or they're my former students. The most depressing day of my life will be a former student that retires, right? That'd be when I'm like 90-something years old. But the baby boomers are retiring, they're leaving. You're hoping they're going to retire because you want their jobs. But what happens when a bunch of them retire and you guys are working 60, 70 hours a week? Will artificial intelligence take over that? So we've got some really huge challenges going forward in the world. And then inflation. Remember, on inflation, you can use the forward curve. So what does the bond market say inflation will be? Because right now it's pretty noisy. It's really, really high. You don't want to use today's inflation. You want to use a long-term inflation. So there, the forward curve could really, really help you on that. I showed you how to do that. It's pretty easy. You do the 5-year forward nominal treasury. You do the 5-year forward tips. And 5-year forward nominal is minus the 5-year forward tips. Tells you what the bond market thinks inflation is going to be in 5 years, getting past all this noise. So if you want to do that, or that the Fed says they're targeting 2% inflation. We don't know if that's an average or a max. If it's a max, they've really failed. If it's an average, they're a little bit in trouble because the average has been coming up pretty rapidly. But there was a time, remember last year, people said, well, inflation's so low. Maybe the Fed should stop talking about 2% being a max and being an average, because we need inflation to rise. And here we are a year later, and we fixed that problem very rapidly. So I think the average is actually going above 2% if you go the last 5 years or so, because the last few months has been so high. But if the Fed's targeting, whatever targeting means, 2%, then that's certainly a reasonable number to use. But the bond market, I think, would be a little more reliable. So, you're talking something in the 4 to 6% economic growth. If you look back at our chart, our economies, it grew 11% in the 70s, but most of that was inflation. You look over time, our real GDP growth has been about 2%, equally split between productivity growth and labor growth. But we also know a lot of women joined the workforce in the 60s and the 70s, and we had the baby boomers and all that. So labor growth is going to be a lot tougher going forward. So our economy has grown about 6% the last several decades, almost perfectly evenly split between productivity, labor, and inflation. Just amazingly how evenly split. I use medians and not averages because if I used averages, the 70s would have really skewed the inflation number. So those are the medians. But yeah, our economy, 4 to 6% growth. I don't see how you can possibly get up to 7%. Because where are the people going to come from? Work, all these jobs and productivity, you know, even to get this, to get to 6%, you're almost going to have 3% productivity. And we just have not been able to produce that. So I think our economy can grow 4 to 6%. I think Trump talked about 4 to 6%. I think he was talking about real GDP growth. That would be really insane. I don't see any way we can get 6% real GDP growth, and then you add inflation on top of that. I hope so. That'd be a great economy. That's kind of a China economy kind of thing. That'd be great. I just, you know, unless we figure out healthcare perfectly and education perfectly, I just don't see how we're going to do that. And what other service industries are there? Construction, house construction, that's pretty heavy labor. Although, have y'all seen the 3D printed houses? Have y'all seen those in the news? That's pretty cool, right? They can print your house from a printer and just these robots show up and build your house based off of some computer program. It's hard to think of too many, you know, McDonald's with kiosks, maybe that's going to fix it. HEB with self-serve lines, those kind of things. But is that really making us more productive? You know, you can debate that. But that's what you're after on paper 3 is you got to figure out what economic earnings, what growth is going to be. I'm going to use 5% because it's right there in the middle. And so return on stocks. My expected return on stocks, it's about anywhere from 6 to 9% would be a reasonable number. Historically, stocks have made over 10%, but that was inflation much higher, and that was with dividend yields much higher. And in fact, you know, I'm taking a dividend yield plus a buyback and getting 2.3%. You go back historically, dividend yields used to be 4 and 5%. So even with me adding a buyback yield, it was still below our historical dividend yields. So it's, you know, it's hard to get stocks making 10% in the US. I just think it's going to be really tough. So that is the expected return on stocks. So what is my market risk premium? Your market risk premium is your required return on stocks minus the risk-free rate. My expected return on stocks is 7.3, assuming that my expected return equals my required return. So my MRP is going to be 7.3% minus 2.4%. What are those two numbers? 7.3, that's what I expect stocks return. So I'm assuming that's what's required. 2.4, what is that? Anybody remember that number? There's not a single person in the room that knows that number. My risk-free rate, right? So what does that give me for a market risk premium? 4.9. How does that look versus a good old demo Darren? He has stocks making let's see if we can find the numbers. Since November 2016, A. This is all of his inputs. I don't know what he means by smooth and annual and normalized, but here's his numbers. So he's got like what, 451 or 363, 599, that's his smooth number, his normalized 366. His ERP last 12 months. I mean, he's kind of all around the numbers. So, but 5% market risk premium is a perfectly reasonable number to use. Why is it important? So here's the big question. How are you going to use this number? So are you going to use the capital asset pricing model? It says for your company, your KE for your company is going to be the risk-free rate plus beta times market risk premium. Why does it matter? Because that's what you're going to apply your beta to. It's going to affect your stock. All right. If your stock has a beta of 1, then your discount rate is going to be 7.3%. The exact expected return is the market because you have the exact same risk as the market. All right. So what you have to do in paper 3 is just write all this up. Where did you get all these numbers? So if you remember, in paper 3, you need the risk-free rate. Hopefully you don't get 2.4% in your paper, you get something different, but you get the risk-free rate. Market risk premium, we just did that using the applied approach. And you need a beta. You can use betas using our 4 steps. Remember the 4 steps: revenue sensitivity, operating leverage, financial leverage, and the historical beta. And that finishes your paper 3. Most of your work is going to be on the beta side, but you have to put a paragraph or 2 on the risk-free rate, a few paragraphs on the market risk premium. You might pull in some of those charts as backup to defend your implied approach. And then the beta, you'll go through all 4 steps on the beta. All right, so that's the entirety of paper 3. I do have a video that walks you through this again. So if you've forgotten all this, you can watch the class and also watch that video. Or you can attend Juan or Gabby's class. They're going to value stocks here pretty soon in their sector meetings. Gabby's just today right after this class. All right, so there's paper 3. Paper 4, what do we need? You need a dividend, earnings per share. You need your KE from paper 3. You need a long-term growth, also probably from paper 3. You need a short-term growth. You need an H. So that's everything you're going to need. You probably need inflation as well. That you'll get from paper 3. So some of the numbers you're going to use in paper 4, you'll pull from paper 3. But you need your firm's dividend. You need your firm's earnings per share. You need a short-term growth rate. You need an H, which tells you how long that short-term growth rate lasts. And then you need inflation. So you're going to spend most of your time here probably on the growth rates, but probably on the short-term growth rate. And I gave you the 3 approaches on the short-term growth rate that you can use. One is the historical. Remember that. I use capital IQ. Use the PEG ratio. Use sustainable. So I gave you 3 approaches. Remember, none of those give you the answer. They just give you kind of a ballpark of what might make sense, because there is no answer. The answer is, what is this firm going to do in the future? Which is, your opinion versus anybody else's. But I've given you at least some basis. You can look at historical growth, the PEG ratio, the sustainable growth. We did those last class, so you saw how those work. The H is just creative writing. There's no, I don't know any place you can go and calculate a number for your H. Are they can grow fast for 5 years? They can grow fast for 10 years, for 20 years. That I can't help you with. You have to just write something about that. All right, the dividend you get from Yahoo Finance. You want the latest 12 months, I'll show you how to do that. Earnings, you get that from Yahoo Finance. If your firm, if you want to do a firm that doesn't pay dividends, come talk to me. We might be able to substitute free cash flow per share. So if you want to do a Google or something like that that doesn't pay a dividend at all, it is possible for us to come up with a dividend substitute using free cash flow, but you have to come talk to me. I have to help you get that number. You're best off picking a number that has positive dividends. You definitely want a firm that has positive earnings, or you may have to normalize to get the positive earnings. So if you want to do a firm like Carnival Cruise Line, which might still be losing money, you can say, well, forget COVID. Here's what the earnings per share would be if it hadn't been for COVID. You normalize it, and then you can use that number. So there's a few ways to do each one of these. So we did the PEG ratio approach for Walmart. We did the sustainable growth approach for Walmart. We looked at the historical growth. And so for Walmart, I came up with 7.5% as their short-term growth. So what I recommend you do, go through all this analysis, but you might do it in a little bit more organized ways. Let's put this in here. You said 2.4% the risk-free rate. The approaches I gave you there, just use the current 10-year treasury or use the forward curve. Right now, it doesn't really matter which you use. I think treasuries sold off today. So we're still around 2.4. They did sell off a lot, 3.5 basis points. So it's, not a great day, but not a horrible day for them. The stock market was up today pretty significantly, right? The Dow wasn't up much, but man, look at NASDAQ. So today was a, boy, I'm kind of glad I bought Facebook. How are they doing today? I bought them like at 190 and they seem to be doing pretty well. So yeah, so Facebook's back up. Now that I've told you that, they're going to crash $50 tomorrow, but still good day for tech stocks if you can consider Facebook a tech stock. So treasuries to 2.4, you can just use the current rate or the forward. I can't think of any other approach. Some students do the normalized approach because I used to do that, but boy, I think that's a ridiculous approach to use now. I no longer believe in that one. The market risk premium, we just did that one, right? We're using the implied approach. I got 7.3%. I'm sorry, 7.3% minus, I'm on the chat. Okay, I don't know what that's all about. So we got what, 4.9%. Be careful on that. The expected return on stocks was 7.3, but you have to subtract the risk-free rate. Some students use 7.3 as their market risk premium, but that's not it. Your market risk premium is your expected return on stocks minus your risk-free rate. So the 7.3 is the sum of these two. In beta, talk about beta for doing Walmart. Remember the 4 steps. Step 1. What kind of company is this? This is a defensive company or a cyclical company? What would y'all say on that one? Definitely what? Does Walmart do really badly in a recession, worse than the average company, or they hold up okay in a recession? Do pretty well, right? This is definitely a defensive company. It's a discount store. And that's where you could actually talk about your company. We don't normally do that, but we've had some pretty good, especially 2008, we've had some pretty good recessions. 2020 is an unusual one. But Walmart did extremely well in 2008, and they did extremely well in 2020. So there's 2 extreme events where Walmart actually flourished. So there's some argument for Walmart there that they've done pretty well. Step 2, operating leverage. And that's where I gave you that spreadsheet. I filed it, I believe. Let's see if I got it right this time. Under papers. There are papers for papers 3 and 4. And here it is right here, Excel file for beta calculation. Everybody see that? I updated it so we have better data. And again, remember what I recommend you do, because there's 3,000 companies in here, is go to the PACE value page first, find your company, and I added the company name. So, you know, like you're looking for Ford, what's Ford's ticker? F. If you're going to search for F, that's going to be a little irritating, right? I mean, you could do F space U, but every ticker that ends with an F is going to come up. But you can do a search on Ford. And well, there you go. Just took me three tries. That's a lot easier than doing F space U. There's just zillions of them. So, all right. So I can do Walmart. There's Walmart. Put it on that line, and then when you come back to the summary, you can just do equal. Go find that line, and it brings all the data in. All right. So it just makes it a lot faster for you. All right, so when we look at Walmart, as you would expect, the standard deviation of their gross and net margins is much lower than that of the typical company. And you would absolutely expect that for a firm like Walmart, retailer with, when you have thin margins, you better have stable margins, right? They have very thin models. Their margins are not 1.13%. The standard deviation of their margins is 1.13%. They rank in the top 10% most stable companies out there. So that gives us some confidence that this is a firm without much operating leverage. You need to talk about it though some. So don't just use this one chart. So we know hourly workers, that's a big part of it. And this is a firm that can, this is a big issue right now, this is a firm that can essentially pass on inflation to their consumers. You know, if gasoline prices go up, Walmart's going to charge more for gasoline. If Apple prices go up, they're going to charge more. This is not a firm, they can't really eat this in their margin because they don't have much margins to start with. So it's a firm that's essentially, I think their gross margin is something like 25%. You know, you look at Microsoft an 80% gross margin. I mean, this is a firm that, boy, when you subtract their cost of goods sold, there's not much left. So they can't say, well, you know, coffee prices are up, we'll just eat that, we'll keep selling to our customer. No, they're going to raise their prices. They have to do that. And you as a customer, you don't get mad at HEB, do you, when prices rise? If they rise at Walmart and Kroger too, right? You kind of understand prices are going up. Has anybody seen people protesting outside of HEB? You know, no more high prices. We have understood fuel prices are up. There's supply chain issues. We kind of have gotten used to that. So this is a firm that can pass it on, but hourly workers is a big part of their workforce. So that just gives them very, very stable margins. So high variable costs are hourly. How do you spell hourly? Hourly workers and very stable margins suggest low operating leverage. This is not a firm with high fixed costs. What does that imply for beta? High beta or low beta? Very low, right? Pushes it, keeps it down. We already said it was low because it's a defensive company, but they also have very low operating leverage. You can tell it in the volatility of their margins. Step 3, financial leverage. This is the easiest one of all. They're slightly above average, but not much. They have 62% debt to equity. The average stock is 56%, so they're just slightly above the typical stock there, but not enough. And you can put these charts into your paper. You might clean them up a little bit, pretty them up some. So only slightly above average company. So a little bit of debt. They did pick up some debt a few years ago when they bought Flipkart. They've kind of been bringing that back down, but that did add quite a bit of debt to their books. Some firms have debt to equities going up, not because they're taking on more debt, but it's because they're buying so much of their stock back. So if you think about it, they're actually maybe even borrowing money to buy their stock back. That's kind of like the double whammy, right? More debt and less equity. So their debt to equity is just going to skyrocket. And the last one you must do in your paper is history. I think I already did history once before. Let's go find it again. So there's Campbell Soup's beta. So let's do this with Walmart. So we're going to use monthly data. We're going to go back 5 years. Why? So that we can tie to this very, very last number here, 0.55. Now, this number had gotten down into the negatives there for a while. Don't pick a company with a negative beta. All right, you're not going to like the results. You get really, really strange results if you have a negative beta. So all you have to do, and you'll see this on several videos that I've made, you just go to historical data. You want the max. You want monthly. And you download it. One thing I will do for you, I'll put out there, is I'll put the S&P. I'll put the S&P out there because Yahoo Finance doesn't allow you to pull the S&P in anymore. Oops. So here's Walmart. Oh, excuse me, that's not what I wanted. I don't think. Let me go see. I want the adjusted close, right? So bring the adjusted close in. And so you go down 5 years, you calculate the returns. Remember that, we calculate the returns. Use the slope function for your company versus the S&P 500, the median, the 90th percentile. What's that last number? Does that look good? 0.55, you've all seen that number before? Is what was in Yahoo Finance, right? So that's kind of nice, even though I'm doing doing February instead of March. And so there's our rolling beta. You got these all over the place. All you got to do is watch the video and just do what I did on the video. I have about 20% of students that just cannot do that. That really worries me. Why can't a student follow that video? So if you're having trouble with that, sit down with me and let's figure that out, because I'm giving you far more instruction than your first job will give you. So if that's difficult, we got to figure out what it is about the way you learn. It might be because I'm just a horrible teacher, but your problem with that argument is a lot of students do figure it out. So not everybody's not able to figure it out. But how do you teach yourself and learn this stuff? Because in finance, there's not much training that goes on. So you kind of have to figure it out on your own. So you got videos to show you how to do these. So there's our history. And make sure you paste it as a bitmap. Or snip, you can just take a picture of it if you like, but do clean it up. So their beta recently has been jumping up a little bit higher. It's been, the median's 0.4. I think 0.4 is too low for me for Walmart. I usually think of Walmart as a 0.7, though I do have to say I was pretty impressed with the last two crises of how they performed. This is a firm that has done, when you most needed a stock to be up, they were up. At the worst possible time, they were doing extremely well. Is that just because the last two crises were just perfect for Walmart and the next one will be different? Who knows? I mean, they're not selling Campbell soup. They are selling TVs, they are selling computers, they are selling clothes. So not everything they're selling is necessarily groceries. They do have a lot of groceries, but to me, groceries is a lower beta than Walmart. So, you know, to me, 0.4 is low for a grocery store. So history suggests 0.4, but more recent is 0.55. The 0.55 is closer than what I think going into this company. So I'm going to use that. But I mean, look at this. It doesn't show the negatives here, so I don't know why the negatives went away. But they were negative there for a while. They may have been negative when they were using weekly and 3 years. And that might have given them negative numbers because of the extreme of what happened in 2020 and what happened in 2008. And maybe that's part of the reason. You can see they got close to negative down here, essentially 0. So the median's 0.4. Recently, they've been extremely low because the 2020 crisis, the 2008 crisis, you can just see they did really well. And that's part of the sensitivity of beta. If you do really well in a really bad market, beta is sensitive to outliers. And so not only is that going to help their beta, but it's going to really bring it down a bunch because they did well when the market really moved a bunch. Remember, we're taking their number minus the average and multiplying by the market's number by the average. When the market's well below average and they're above average, that's going to give you a huge negative number. And so beta is very, very, very sensitive to outliers. And so part of this right here recently is probably, I don't know what happened here. That's a really interesting one. But definitely COVID-19 brought their beta down. But now I think, to me, this is like more normal levels. And remember, what you want to do on beta is put those things in there at the end, all of them: revenue sensitivity, operating leverage, final leverage, history, and then come up with your final beta. Are your final betas. What I mean by betas, now I might use 0.5 for Walmart, but I might say, but I think it could range between 0.4 and 0.7. So I might actually have ranges that I use in paper 4 because I'm not absolutely sure, but I'm going to go with that for right now. So there's my beta, 0.55, 0.7. Don't do sensitivity analysis on the risk-free rate, market risk premium. You don't need to because we're valuing Walmart to see how they stack up versus other stocks. Every other stock we're looking at is going to use the exact same risk-free rate and the exact same market risk premium. So there's no reason to do sensitivity on that. So the beta is the main thing. So when I do that, I get a KE for Walmart of 0.024 plus 0.55 times 0.049, a really, really low discount rate. I didn't mean to do that. Plus that, times that. So 5.1%. Now, why is that 5.1% so critically important? Well, long-term growth, by short-term growth, what did I say for long-term growth? I mean, short-term growth, I can't remember. Yeah, I was going to use 7.5%, right? That's what I decided. And I use 6% for long-term growth. Anybody see a problem with 6%? What's the highest your long-term growth can be? The absolute highest it can be. Anybody have a guess there? It's on the page. Remember this from 2013. Your long-term growth rate, I won't pick on Sebastian, he was in that class, but your long-term growth rate cannot be higher than what? Say it again.
Like the growth of like the economy.
Well, it can be higher than the growth of the economy if you're doing Google. But that number's not up there either, so, but you're thinking along the right lines. Let me give you a hint. The value of a stock equals dividend 1 divided by KE minus long-term growth. So what can long-term growth not be greater than? Your KE, right? Yeah, if it was greater than KE, what would you get in the denominator? You get a negative number, what would your value be? Your value would be a negative number with this formula, but then is that really your value? Absolutely not. If your growth rate is greater than your discount rate, the company is worth infinity. Do any of y'all think Walmart is worth infinity? If you called your broker and said, hey, Walmart's currently trading for $87 million, it's, oh, I'll take 1 million shares. I think it's worth a lot more than that. Would you do that? Probably not. Right? Is Walmart worth more than infinity? No. If Walmart's not worth more than infinity, then either your discount rate's too low or your long-term growth rate is too high. You see why a low beta can cause you some problems. A low beta is going to give you a very low discount rate. It's also going to put a constraint on what your long-term growth rate can be. So you've got to fix one of those two. All right. So what could I use? Well, I said the economy is going to grow, what did I say, 4 to 6%. Walmart's a fairly mature company. Remember, if the economy is growing at 6%, big companies like Walmart can't grow that fast because we've got a bunch of small companies coming in that are growing much faster. So I might use a 4% growth rate for Walmart for the long term. So you're going to tie it somewhat. If you got a bigger company, I might come 1% off of your economic growth assumption, just because we have all these new players coming in, that kind of thing. Your short-term growth rate can be whatever you want it to be. It can be 80%, it can be negative 40%, whatever you want the short-term growth. There's no limits there, but your long-term growth rate must be below your discount rate, all right? Now I'm saying that, but every semester I have at least 3 or 4 students that their valuation on their stock is like negative $135. They turn that paper in, and they say, I think this stock's overvalued. And it doesn't faze them, and I don't understand that, right? Sometimes you have to stop and look at what you just said, right? Some students kind of go through the motion, and that seems kind of strange, right? If I came to you and say, hey, I think Walmart's worth negative $135, when you kind of look at them, so you're telling me if I had Walmart stock, or if you had Walmart stock, you would give it to me for free and think that was a deal? I mean, yeah, give me all your Walmart stock. I'll take it away from you for $0. If you think it's worth negative 135, I'll take it for $0. Give me, I mean, does that make any rational sense? And yet students will put that in their paper because they don't step back and think about what did I just write, right? So you cannot get a negative value. If you do, it's probably because your long-term growth rate is greater than your discount rate. And that's not because the stock's worth negative numbers. That's just a formula problem. The formula doesn't adjust for that. That means your stock's worth infinity. I'll even prove it to you. You got a company paying a $1 dividend that's growing at, let's put the KE at 5% and long-term growth at 4%. We go out a few thousand years. And what's the value of the company? Well, we just take that divided by 1 plus our discount rate, raised to the time. So our value is just the sum of those. $99, or what else can we say? It's $1 divided by KE minus the growth, $100, right? The value of a stock is the present value of its future cash flows, or we use this formula, it's next year's dividend divided by the KE minus the growth rate. The same thing, right? You see how that gives you the same answer? What happens to these discounted cash flows over time? They get really, really, really small. What doesn't happen to these cash flows over time? If my long-term growth rate is greater than my short-term growth rate, than my discount rate. When do these future cash flows approach zero? How many years do I have to go out until my present value of my cash flow approaches zero? Is it getting any closer? Not getting any closer, is it? How many years do I need to go out? If I went out another 50,000 years, would that get me closer to zero? It's what's the value of Walmart in that case? It's infinity, right? So your growth rate has to be less than your discount rate, and then the dividend discount model works. The interesting thing though is that while this will give you a positive number here, the dividend discount model gives you a number, negative $100, but it's not worth negative $100. It's actually worth, well, more than this number, right? Because I need to go another trillion rows, and then Walmart would be worth a lot of money. So make sure your long-term growth rate is less. One thing to be careful of though, if I decide my long-term growth rate is 4.99%, you can get a really massive number. So as your growth rate approaches your discount rate, you start approaching infinity. I mean, you get really, really close. Yeah, it's just a massive, massive, massive number. All right, so that's the other thing to be careful of. Don't just make sure your long-term growth rate's lower. If your discount rate's 5%, don't use a 4.9% discount rate because you're gonna get a really wild answer. So that's one of the advantages of using a company with a higher discount rate, a higher beta, because that does avoid some of that issue of you getting these incredibly high valuations. All right. So with these assumptions, we can value Walmart. So what models do we have to use? So on paper 4, you have to use 4 models. One you already know, the dividend discount model. You should have had that one in 3013. The other 2 you probably don't know, except for Sebastian, he's the only one. The H model. I love the H model. I discovered it on the CFA exam. Really, really good model. Very simple, but very powerful. I really like the H model. And then we're going to do what we call capitalized earnings model. That's my own creation. Dr. Demadarin thinks this is a horrible model, so that gives me even more confidence. I like to be out there on the edge. So this is entirely mine. Be careful you don't bring this up in an interview because I have no clue what you're talking about. Or if you do, you got to talk about it, which means in your paper 4, you can't just use the capitalized earnings model without explaining it. So you have to put some words around it because the H model and dividend discount model are better known. Dividend discount model, everybody knows. You don't have to explain that one. H model is not as well known, but it's at least out there and published. Cap earnings models is my creation. So how does Dr. Demadarin talk about it? Well, he just happened to be talking about the same model, not because it's mine, but someone else had mentioned something to him about this. So those are the 3 we have to use. Dividend discount model, I already gave you that model. It's dividend 1 divided by KE minus long-term growth. Very simple model. Y'all remember this from 3013? That's probably this formula probably 20, 30 times. What if you don't have dividend 1? What if you have dividend 0? Then dividend 0 times 1 plus long-term growth. So you just take dividend 0 and you grow it 1 year, and then you do that. All right. So either one of those 2 would go. H model looks almost identical. what the H model does is takes the dividend discount model. And it says, you know, there's some firms that are in an unusual growth period. So what we're going to do is we're going to tag on this extra growth. So we're going to take dividend 0 times something called H times short-term growth minus long-term growth. We're just going to add this piece right here to the dividend discount model. So it's the exact same formula as the dividend discount model, but you just add that little section in there. So there's no reason for me to give you a formula sheet because it's a very simple formula. All right. Everything's the same except for this H, and we'll talk about the H more in next class. But this H, we got to figure that out. But short-term growth for Walmart, we said that was 7.5%. I don't know what I said yet. I think 4% for long-term growth. For capitalized earnings model, we'll have to talk about that one. But that one is essentially the dividend discount model again. But instead of using earnings dividends 0, you're going to use earnings per share, and instead of using growth, we're going to use inflation. So I'll explain this again in the future, but just real quickly, my thought here on this model is let's value the firm as is, without any new stores being built, without any expansion. Let's take their current earnings and assume they pay out all of their earnings as dividends, so they can't grow anymore except for just inflation. That's where Dr. Demadarian disagrees with me. He says they can't grow with inflation because they're paying their earnings out, but I actually think they can grow with inflation if they pay out their earnings. So it's essentially asking, what would Walmart be worth if they just didn't add anything to their capacity? Just as is. So those are the 3 models you'll put into your paper. So you see all the assumptions that you need. Let me show you real quickly. You got about 3 minutes. Where can you get dividend 0? So for Walmart, look right here. Y'all see that little button, historical prices. Change that to dividends only. And you just want their last 4 dividends. So 56, if they pay quarterly, make sure this is quarterly. You know, if they pay monthly or once a year, just be careful. But you want their last 12 months of dividends. All right, so you would just add those 4 numbers up. If we're doing Campbell's soup, pretty easy, right? Just add those 37 times 4. Now, Yahoo Finance used to provide that number, and then someone in Yahoo Finance, I don't know why, but they decided to do this for dividend yield. For dividend. Is that dividend 1? No, it's not dividend 1. So I want to argue with whoever put this on Yahoo Finance. What had to do with this? They took the last dividend multiplied by 4. It's not what people are expecting their dividend to be the next year. They just took that 56 cents times 4. You can see what that is, right? 56 cents times 4 is 224. It's a ridiculous number. I don't know why they did that. They used to give you that previous 4 quarters, and they stopped doing that for some reason. So, all right. So next class we'll finish it all up, and we'll have an entire valuation of Walmart. Do you think we're going to be buying Walmart or not? All right, so today I want to talk about paper 2. Paper 2 is another good one to put out there on LinkedIn. Pretty straightforward paper. Let me just high level say what you would expect to be in a paper like this. I'll show an example paper, and then we'll practice a little bit with, you can bring, load your paper. So your boss has asked, maybe you own this stock and you have to do a report on the earnings. This was pretty common. I still remember when I was a security analyst going home one night and no one was leaving. I felt, you feel really guilty, right? You're going to go home at 6 o'clock. Everybody's just sitting there and you're like, why is everybody just sitting here? I had no earthly idea. I might have told y'all this story, okay, but before, but I'll tell you again, but no one's leaving. Why aren't they leaving? What's going on? So I finally have the guts, they want to ask because then you're really stupid. So I asked the person who was probably, couldn't get me in trouble. The guy sitting next to me, because he was pretty new too. Why is no one going home? And he's like, IBM, they're reporting earnings today. Now, IBM used to be important. They're not important now, but IBM used to be the most important computer company. It used to be the biggest company in the world, it may have been the biggest company in the world, but biggest computer company in the world, and bigger than all the others almost combined, just massive company. So when IBM reported, it was the most important number. And I knew exactly when they reported because the place just went wild. People were running back to their desks, updating their models. So earnings announcements are very, very, very important. You're trying to forecast this company out 50 years. You only get one more quarter of data, but that's really important to markets. It lets them confirm their assumptions. They can test their thesis. They can hear management talking. So you're going to write a report for your boss. So what would be in it? Well, one thing students lose points on is, to me, kind of an obvious thing. You're writing this paper for me, but you want to put it on LinkedIn. You need to start with, what am I doing? In this paper, I will, makes a lot of sense almost in any paper, doesn't it? Why are you doing this? So don't just start writing, this company reported $4 in earnings. You're going, wait a minute, what company, what are you doing? Who is, so start off. A lot of students do that in an abstract. Before they do the abstract, a lot of them will say, do an intro on the company. That may make more sense. Let's say, here's who this company is. In this paper, I'm going to talk about their earnings report. They go in either order. I think most of them say, okay, this is who Best Buy is. Best Buy is a main retailer, blah, 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 in the US. In this paper, I'm going to talk about their third quarter's earnings release or whatever, or their March 22nd earnings release. All right, so give it a start. You can do that either in the abstract, in the first paragraph, but up pretty soon, pretty early on, you want to talk about what you're doing, why you're doing it, and who the company is. Then you'll probably talk about earnings per share. Now, here's how you have to have the decisions. So some students really struggle with this. Your goal in this paper is what happened and why, and the reaction. Your reaction should be all at the end, but the what happened and why, do you report to all the numbers first and then do the why? That's kind of where I would be. Or do you report EPS and talk about the why, then do revenue and talk about the why, then do margins, talk about the why? Well, then the challenge I have with that is it gets a little redundant, right? So earnings are up, but revenue is up. Well, maybe earnings are up because revenues were up. So, you're kind of redundant. So my preference is, let's just get all the numbers out there. Maybe you do EPS and revenue and then talk about the why, and then you get specific at the margin. I'm more of, let's just report the numbers. Let's get them all out of the place. So EPS, revenue, margins, and then the why. And why what? Why beat? Why miss? Why hire? What's going on? And this is not your subjective opinion, all right? You need to go read some articles. What did management say? What are articles saying? All right, so you need some support. You need documentation, all right? Don't tell me their revenues were higher because they sold more. That doesn't tell me anything. I remember my first accounting presentation. That's essentially what I did. Our annuity revenues are up because we sold more annuities. And the CEO is like, oh, great, I'm glad we're paying you all this money. So why did they sell more? Well, we sell more because we have more customers. All right, you're still not getting anywhere. Why did you have more customers? Is it because of COVID? Is it because coming out of COVID? Is it because some new advertising, some new product? Is this just taking off? There's this hype, whatever reason. Try to figure that out. Your best quotes are management or an investor. Those are the best quotes. Your third best quote is some journalist writing an article, because we don't trust those guys because they're not finance people and they tend to write a lot of these papers, they're a little stretched on what they're doing. So as much as you can here, quotes are great. Management quotes are biased, right? Because management always wants to put a good spin on it. So if management quote is usually good, though, I would want both in there. What is management saying? What are analysts saying? One of the best things I do, and Lena and Sebastian, I don't know if y'all found, did I show you all the BRC? Did we talk about that? Yeah, so the BRC, I don't know if you found it on Williams-Sonoma, but if you go on the Bloomberg machine and you look up the research reports, a lot of times there'll be a research report talking about the earnings announcement. I mean, that's like a gold mine. Can't do much better than that because they're writing the exact same paper you're writing. You got to quote them. You can't just, plagiarize from them. But I mean, that you can't beat that. The bigger the company, more likely that is to be the case because that's what the sell side does. The sell side writes research reports, and a lot of times they'll automatically write one when a major firm reports their earnings, the firm that they're following. So quotes are always really, really good. And then you have the stock market reaction. Now, some students get confused. I'm not asking how did the S&P react. I'm asking how did this company's stock react? All right, that's really important. So I have some students say, yeah, the stock market reacted positive, it was up 2%. No, that's not what I'm asking. It's one stock out of thousands. How did your particular stock react? So your stock, and then you compare it against the market, the industry, key competitors, those kind of things, right? You want to give it some context. Now, some students lose a lot of points here. You got to make it, you're sure you do it the day of the reaction. All right, you got to talk about that day. I need the dollar amount change, the percentage change of the day of the reaction. All right, I saw one paper, they talked about the previous day's open. We don't really care about the previous day's open. So if it came out before open today, you want yesterday's close, today's open, and today's close. All right, we don't need yesterday's close. So we're really focused on the day. If it came out after close today, then you want today's close, tomorrow's open, and tomorrow's close. All right. So you want to make sure you're looking at when it was reported. I essentially gave that to you. And if you're not sure, I showed you how you can do that in Yahoo Finance. Remember, you bring up the historical prices. You can almost always tell it's the day when the volumes jumped, because volumes almost always jump on the day of. So if you're not sure if it's the 22nd or 23rd, just look at the historical data and see when did the volume jump. That's the day you want to focus on. And that's the day you want to look at the previous day's close, today's open, today's close. That's what you're after. Now you can do year to date, trailing 12 months. If you want to give it more context, how's it done year to date? Last 12 months can be interesting. The last couple of years, a lot of students were looking at it since COVID. It's kind of getting a little distant for that, but you want to say, well, COVID really hurt them, but they've come back strong. That's a little bit lengthy, unless you're doing something like Carnival Cruise. They closed at $50 December 2019. They're still only back to $20. Something like that. You can say, yeah, their stock's up year to date, but they're still below where they were at COVID. That might make sense. You don't really have a stock like that in this one. So there's a lot of different ones. And again, you want to talk about the why. The why you really want to focus in on the day. Why did the stock market react? If they beat and the market's down, that gives you have a really challenge there. They had good numbers and yet the market reacted negatively. Why is that? Hopefully you explain that up here in the quotes and what management said. You have some basis. So hopefully you can explain that. That's where articles help you as well. You'll see it in the title, right? So-and-so beats, but the market is down because. That's what you're looking for, right? This is detective work. And then you probably want a summary. What's the summary? Well, the summary is pretty easy. You go back and look at everything you said and you decide what were the 2 or 3 most important things I just said. Out of everything I just said here, what's the 2 most important things that are most critical? And that's essentially a good paper. How long should a paper be? Yeah, long enough to accomplish all of that. All right. Don't ever ask your boss how long should this paper be. It needs to be long enough to do the job. That's part of the critical thinking of the job. All right. So that's the basic thing. Remember on revenue, and we'll talk about that. Reported versus expected versus prior year, same quarter. That's just the standard that you see. You see it in the articles and everywhere else. Some of y'all have been asking me, what if this quarter was their fiscal year end? I don't care about that. We actually don't make that much of a distinction. There's a little bit more words if their quarter ended this quarter, but I don't really care about that. All right, you don't need to focus so much on that. And it gets confusing. Some are like, isn't this first quarter? Well, the firm's first, second, or third quarter is not based on calendar years. It's based on fiscal years. All right, so this could be their third quarter, could be their second quarter, could be their first quarter. If it's their fourth quarter, you'll probably see more discussion about the full year revenue and earnings, those kind of things. But I don't need you to do that. I don't really care. So just focus on the quarter. That's really where the markets focus as well. That's, they know the year to date anyway. So don't worry so much. I don't really care if it's third quarter or second quarter or whatever. Just say the report of earnings that came out on March 22nd. Just focus on that. But make sure you do compare it to the same quarter last year, because seasonality is pretty important. One of the nice things, I worked in insurance and banking. Insurance companies, banks are almost always calendar year fiscal years, because they're regulated. Everything's calendar year, and that makes it really easy. I've never had to worry. I watch your fiscal year end. Retail companies like Walmart is usually January, February is the end of their fiscal year, because they want to get through the holiday season. They don't want to do December, close on December. You're right in the middle of holiday season and gift cards and everything else. It gets really confusing. So let's look. I'll show you another paper. So this was a really good paper here. So the title tells what she's doing, earnings announcement. She gives the date. She did a little bit of a kind of a summary. Bed Bath & Beyond is a struggling company, isn't it? I go to Bed Bath & Beyond like once every 3 years. Anytime I go to Apple to get my phone fixed, I hand them my phone. Next door, I go to Bed Bath & Beyond, buying some smelly soap, and go back and get my phone. That's the only time I go into Bed Bath & Beyond. They just happen to be next door. So she gives a little bit of an introduction. I do like on a paper like this, somewhere say the purpose of this paper is. So in this paper, I'm going to, or the purpose of this paper is to, just say that definitively. She doesn't really quite say that here. Make sure you give a background on the company. What do they do? You can definitely go to Yahoo Finance and take their description and reword it. It doesn't have to be, try to get it down into a sentence. She has a little bit of extra discussion here, which is okay. She does the earnings per share. You can put this chart in here. If you type EE in Bloomberg, it will bring up these type of charts, and you just change it to annual, and you can get a really cool looking chart. She didn't do that. She built her own or something, but these kind of charts can be interesting. So she did the why immediately. So she just gave the EPS. Now she's talking about why. She's talking back to school and those kind of things. She has a good quote from the CEO. I do like having a quote from the CEO or CFO in the paper, because that's when we're after. We know it's biased, but we get some sense of the management. One thing I do look at quotes is, does it tell me anything? So you don't want a quote that says, according to so-and-so at Reuters News, the reported earnings were $2.20. That's not a good quote. Quotes should be insightful on the why, all right? Not on the why. You don't want to quote the why. You want to quote the why. Why did this happen? Why did they do well? Why did they beat? Why did they miss? So you want those type of insights. So let's look at this quote. The final and largest month of our second fiscal period, traffic slowed significantly and therefore sales did not materialize as we anticipated. COVID fears reemerged amid the Delta variant. We experienced a challenging environment. This was particularly evident in large key states. That's pretty insightful, right? That tells me quite a bit right there. COVID hurt Bed Bath & Beyond. You would think they might do well. I mean, I don't know if they sell hand sanitizers, but people are probably not worried that much about that kind of purchases. They're probably loading up on different type of things. So that was a good quote. Top line growth, talks about revenue. This chart not as exciting. Why? Because we tend to get revenue much more closely, but it can be depending on the company. She talks about that as well. She's probably going to have some redundancy here because she just talked about foot traffic. Well, obviously foot traffic drives revenues, so there's going to be some. Another quote from the CEO, one of the critical missteps we had was really that we called back key vehicles that had been traditionally strong traffic during drivers for both digital and stores and engaging our customers even with coupons. And that was really the reduction in circular, which was dramatically cut. Man, this guy is kind of hard to understand exactly what he's saying, but we didn't get clarity on that too much later in the quarter, and it had a real impact on traffic. Boy, I'm not sure what he just said, but he said something there. You know, try to find quotes that are a little more to the point. Sound like he had something to drink between the two quotes. Talked a little bit about prices. Bottom line, you can say bottom line or just call it margins. To me, gross margin is not bottom line. She showed the gross margin. I would not put a gross margin. Gross margins are about the easiest thing to forecast. So you got a bunch of lines that look the same. If you are going to do gross margin, then I would change the scale so you can just see, you know, it's hard to tell anything's moving there. I think that's a little much. Talks about versus last year. EBITDA margin, below estimates, missing by 332 basis points. A chart there can be more interesting. I would definitely change the axis. When you're doing the axis, try to get as much white space as possible so you can really see what's going on. She gives a little more discussion here. Sometimes you can, because revenues may be up or down. Gross margins are pretty predictable, but expenses, selling expenses, marketing expenses, those kind of things can be controlled by the company, and there can be things going on there. It can be research and development costs. So again, she's quoting the company. Our SG&A dollar expense was in line with the original plan, but therefore higher as a percentage of sales given the lower than expected revenue. So margins fell not because they spent more, but because the revenues were down. Okay, that kind of tells you. She says what professionals are saying. I don't know what she's still quoting management, but she's giving some more on the why. Again, the CEO. So here she finally gets to someone that's a analyst outside the company. We believe quarter two's hiccup undeniably casts doubt on their ability to deliver on a multi-year turnaround plan, and considering a more challenging environment featuring low supply chain visibility, enhanced execution risk, we're taking under lower estimates and reducing our price targets. So pretty negative. That's insightful. Management's saying, hey, this is COVID, it's temporary. He's saying, no, I don't think it's all that temporary. All right, and then you got the market reaction. So your market reaction better have a graph in it, okay? You better have a graph in your market reaction. I gave you a graph in the Excel, but you can probably create a better graph than that. I'm seeing a lot of graphs like this. This is a pretty common one. They're getting out of Yahoo Finance, so you know that's perfectly fine. Usually 2 days. I forgot how in Yahoo Finance to get the actual dates, but you can control that. Make sure you give the stock price, give the percentage change. Definitely give the price at close. You don't have to give the other prices, but you can. But definitely give probably you're going to give the close on the previous day and the close of the current day in dollars, and give the percentage change. Make sure you have the percentage change. A 22% drop, that's a pretty big drop. She compared it to the TJ Maxx. That seems a little unusual to me. Who would you compare Bed Bath? TJ Maxx to me is a clothing store, right? I've never been in a TJ Maxx. So who could you compare? There's not too many people left with Bed Bath & Beyond, are there? It's kind of hard to compare them. So I'm not sure who else you would, but I wouldn't think of them. So I would probably focus on consumer discretionary more than a particular competitor. But she compared them. There's some in here on supply chain. I think today you're probably going to be talking about inflation. You're probably going to be talking about supply chain for a lot of your companies. I think that's going to be pretty critical. With inflation as high as it is, that's probably passing through your company. So that's where your gross margin and net margin discussions are going to be pretty important. You know, those obvious things that are in the news, like COVID, coming out of COVID, even, you know, the Russian crisis is definitely impacting certain supply chains, the oil prices, transportation costs, those are all in there. So those are the obvious things, and yeah, bring them into your paper. She compares the two stocks together. Again, I'm not sure TJX is the most logical one. She brings the S&P in there. I mean, Best Bath drops so much that the graph doesn't really help you that much. I think if you're going to do something like this, you're probably better off if you're going to do, especially if your stock moved a bunch. I think, you know, talk about the day. I think a graph where you show them year to date, to me, makes a lot of sense. Because your boss doesn't keep track of every single company. So I would say, hey, this is what happened on the day. And oh, by the way, year to date, they're way behind the S&P. The S&P's up 7%, they're down 15%. That to me is more helpful than just the day up. So I tend to jump back to the year to date when I'm looking at it versus a competitor or versus the industry or versus the market, because I think that just adds more. Now, what she didn't do, which I think she needed to, was what this all means. Bottom line, what does this all mean? And that's where you want to save your best quote for last. Someone that just brings it all together, especially some analysts, that's really where you have it the strongest. So you look through all of that, you read through it. It's not the 7 most important points. It's the 2, maybe 3 most important points that you want to get out of this. What does this bottom line, does this mean? There's a good chance that's the first place your boss goes, because that may be all they care about. Like, you know, I got 50 companies I'm following. I'm just going to read your last paragraph. So make sure there is one there that makes it really clear. All right. So she did a pretty good job, other than she didn't have a good summary at the end. She went with the numbers why, the numbers why, the numbers why, versus I tend to be numbers, and then the why. It just kind of depends on the company and what you're trying to do. If you look at the numbers themselves, here's Burlington. I don't know if anyone's doing Burlington, but I do count off on clarity, and this is part of me. You know, think about your writing and your communications. So you should, each time you edit it, the paper should be getting shorter and shorter and shorter as you edit it. So I think some of y'all, it's almost like you want it to be more pages. So you take something that could be said in 1 sentence and you're going to convert it into 7 sentences. And it's just painful to read. Especially you're going to put this out on LinkedIn. You don't want it to be like that, all right? So I look at this first one. So they reported 253. Expected was 326. Last year was 244. They missed by 22%. They're only up 3.9. Can we get all of that into one sentence? Do you think that's possible? So Burlington reported $2.53. Which one would you go to first? What do you think market's most focused on? Last year's or the estimated? The estimated, right? So how would we get that? Missing expected of 3.26 by 22.3%. But higher than prior years, 2.44 by 3.69%. It's not even that long of a sentence, is it? Could you write it better than that? Probably could. I'm doing it by staring at me, but how efficient could you get that sentence? Does your boss need that in 6 or 7 sentences? I've seen some students do it in 6 or 7 sentences and the 253's in there like 3 different times. You don't need that. That's wasting your boss's time, all right? So get it efficient. Get it down to a very, very clear sentence. Could you do the same thing with revenue? Be really easy, wouldn't it? You just substitute the revenue numbers. We're real simple. Make sure if it's in billions, you have the word billions in there. Okay. So revenues is in billions, so make sure you have it in billions. So if you look at revenues, anybody want to try it? Early reports, what? $2.61. Oh, you know what? I left something out, didn't I? Who's this? Someone's asking me a double column. I don't care how you do it. I think double column looks a lot more professional. What did I leave out here? I forgot to say what it was. So make sure you say what it is. Reported earnings per share of, you only have to say EPS once, so you don't have to say it each time. EPS of 253, missing expect, you don't have to say expected EPS. You can say missing expected of 326 by 22%, but higher than prior years 244 by. So say EPS once, so we know it. When we go to the revenue, reported revenue, Bill Gates, I don't know why he doesn't let me know the cap locks of $2.61 billion, missing expected 2.77 billion, 5.78%, higher than prior years, 0.28 billion, 14.28%. That's pretty significant revenue growth. That's also a very significant miss. You don't usually miss on revenues as much as you miss on earnings, and they miss on revenues by 5-6%. That's a huge miss. All right. So try to get it in one sentence. I don't even try to put the Y in there. Just here's the numbers. You might do a table as well where you can do all of them and just have red for miss and green for beat or whatever. One thing I do have some students who will say lower than expected. We just don't say lower. We say beat or miss. Okay. And I have some students say beating prior. We don't say beating prior. Okay. You beat or miss expected, you're higher than or lower than prior. Okay, everybody see that? Sounds really strange to us, and not that it's wrong, it just sounds really strange to say that you beat last year. That just seems strange to us, all right? Either you're higher than last year or you're lower than last year, okay? You do the same thing with gross margin. Here, you're going to do it in basis points, 153 basis points to 80 basis points, because why? It's a percent. When you're talking about a percent, shift to basis points. Makes it much easier to do. Again, the same four numbers, you just take that sentence. I'm going to probably see that sentence now like 80 times, but that's all you need. Keep it simple. There's no reason to be creative writing when you're just giving numbers. And then on EBITDA margin, exact same thing there, talking basis points and percents. You can get the dollars if you want to, but the real focus is on the margin. We're really focused on, EBITDA is up 5%, but revenues are up 20%. Some margins must have shrunk some, and that's really where the inflation is going to come in and those type of impacts. All right. So the why is very, very important. It's a big part of the paper. So make sure you should have at least a few quotes in your paper. You want to have quotes from management. You want to have quotes from analysts if you can. If you can't find analysts, then, some articles. Most of the financial journalists, they know something about finance, so they can somewhat intelligently talk about it. It's just they don't have skin in the game. And then you get into the market reaction. I gave you this. I guess I didn't give you a graph, but I gave you this so you can see the stock market. They dropped 12.95% on that day. This is on the day. The market was down slightly, and I don't remember what this is. So you'd have to look up that index, but an index of competitors, I guess, was down 2%. So this tells you the day too, because this is 2.2 to 2.3. So 3.3, 3.2 to 3.3. So 3.3 is the day we're interested in. So for Burlington with 3.3, so we have to, see, y'all tell me, boy, it's been a while since I've done, it's much easier to do this in Bloomberg. I don't see. How do you change the dates? Y'all remember? I don't see the calendar. What do y'all see? Well, I clicked on that, but it doesn't give me a choice to. Yeah, it's on that. So I don't know how to do that. It's much easier. I always do it in Bloomberg. In Bloomberg, you just use either the GIP function or probably the GIP function. Use the GIP function because it gives you the intraday, and just you might do 3.1 through 3.3 or something. You don't want more than 2 days on there, but it does kind of help to see the previous day and see the current day, so you can see the big drop. I mean, here's the drop right here, 3.1 to 3.2, and you can somewhat tell that's the day it reported because that's when the volume is so high. But I just want those 2 days, but I don't know how to get those 2 days on this particular chart. So there probably is a way to do it. But make sure you have a chart in there. If you're not sure how to get a chart, then catch me in FSC and I'll show you how in Bloomberg to get a chart. Bloomberg charts are pretty cool because then you have a Bloomberg chart in your paper, which is impressive that you know how to use Bloomberg. And I'm sure there's a way to do it on the internet. I just I don't do that anymore. All right. So questions on that? It's a fairly straightforward paper. You have to read some. You can't just make it all up. You can't just make up why you think it's moving. You need to know definitively what's going on. You can certainly go to their website and listen to the earnings conference call if you want to. That can certainly help quite a bit. They're kind of boring. I don't think many of y'all tried that, but you can certainly do that. It gives you great insight. You can go look at research reports on the company and see if, I would at least check if I were you. I would definitely just check and see, did someone write, Barclays, JP Morgan, Deutsche, is one of the big sell side firms write a paper just on this earnings report, because that would essentially got everything you need. That would be just the most wonderful thing you could find, especially if it's one of those firms. There are some firms that it's not going to help you much because they're too technically oriented or just don't do a good job of writing. But the big ones, JP Morgan, especially in Deutsche Bank, I keep watching. We have UTSA alum at all those schools. I mean, all those companies. I'm always looking for their names, but I haven't seen one other than JP Morgan. Ryan was there, and I've seen his name on their reports, but I haven't seen the other ones. So I need to check with them why their name's not coming up. And it's probably just because I'm not hitting their industry. But that'd be the coolest, right? You find a UTSA alum writing a report on the company you're doing. That'd be like perfect. All right, everybody's got it. So let's do this Friday. If you have questions, call me up. We can walk through it. It shouldn't be a difficult paper. Some students struggle with it. I'm still kind of in the camp is this should be really straightforward. If you're not sure how to do this, then you have to kind of rethink how you tackle work because I'm giving you much more guidance than your first boss is going to give you. So you have to somehow figure out, it may just be the way you tackle assignments, how you teach yourself, how you figure out things on your own. Because it's all out there. It's very easy to do. You can even just go Burlington earnings report. Investor relations, so that's going to be a little bit biased. Burlington store earnings, stores seeking alpha. Doesn't always give you great insights, but you can at least double check your numbers. Burlington is not the best, it's a smaller company, so it's not going to have as much stuff written about it versus some of the larger ones. Press releases, yeah, I mean, if you want, it doesn't hurt to get the company's side of it. So there's an article. There may be something in there. So you should have no trouble finding the firms I picked for you. Should have stuff. Now I saw at least one of y'all was doing GameStop. Yeah, I mean, if GameStop, there's so much noise around it, you're probably gonna have to kind of weed through the noise because there's so much else going on with the company. But it's an interesting one to do. But the other ones should be fairly straightforward. Here's the CEO talking about it. It's actually a recording. There's all the sell side people. So yeah, I mean, you shouldn't have any trouble finding stuff. All right. So let's finish up our stock valuation. So here we're going to talk about the valuation itself, but we have to bring these growth rates in. So you're going to use the dividend discount model. You should have seen that in 3013. Very straightforward model, very straightforward and easy model. You take dividend 1 or take dividend 0 times a growth rate or dividend 1. You won't actually have dividend 1, so you'll be using dividend 0 times a growth rate divided by K minus a growth rate. You only get one growth rate with this model. That's the big weakness of this model. Remember, your growth rate has to be lower than the KE. It has to be lower. There's no options. It's not like it's usually lower, or most of the time it's lower. No, 100% of the time, KE is higher than G. It has to be. Now, we're using dividends, but most of us think about growth in earnings. Why are we using dividends? Because that's the cash flows. So we don't value earnings, we value cash flows. So we're essentially assuming dividends will grow at the same speed as earnings per share. Now, if you look at Walmart or some of these other companies, dividends, like for Walmart, their dividends just go up every year. It's, 4 dividends the same, up a penny or two, up a penny or two. So this is very, very gradual slide up, and the earnings are more volatile than that. But I bet if you looked over long term, they do grow about the same speed over like 10 or 20 years. But in any given year, it's probably way, way off. Is that a bad assumption? Well, technically we shouldn't be using dividends. We should be using free cash flow. So there's a big assumption about the dividend discount model is that the dividends the company pays closely approximates the firm's free cash flow. What's the chances that's not true? According to Dr. Demadaran, probably about a 95% chance that's not true. He says this model works well for about 5% of the companies out there. So it is a stretch to say that a firm's dividends approximate its free cash flow. We were looking at a company today, what was it? I can't remember, Walker. It was a chemical company. And we looked at their dividends. The dividends was like $1.50. Their free cash flow was $13. Is there a difference between $1.50 and $13? Pretty huge difference, almost a 10-fold difference in the valuation. So, what do you do with that? You're using dividends. You can substitute free cash flow instead of dividends, and you'll learn that if you take corporate finance, especially Dr. Katapakam. He does free cash flow models. Academia really pushes free cash flow models. They're fine. You have a huge issue with free cash flow models. Dividends are dividends. That's a piece of cake. You just go look at the dividend, you've got it. Free cash flow is not a number that's reported anywhere. Companies don't report free cash flow. That's the number you have to calculate, and there's a lot of debate about how to calculate it. So it's a very debatable number. If you go to Bloomberg will give you the free cash flow per share for your firm, but that's the way they calculate it. It may not be the way you calculate it. So that's the downside of free cash flow, is it's a theoretical number. And I've got a blog on that if you want to read it. And it's just, how do you come up with free cash flow? It's a debatable number how to do it. The other thing I don't like about free cash flow models is my students in my security analysis class, they'll use free cash flow models. It always gives them a weird answer. So they don't like it from that standpoint. So it's a little bit questionable. So we're assuming the dividends they're paying reflect their true free cash flow. This firm's producing free cash flow, and instead of reinvesting in the firm and growing the firm, they're just paying it out to their stockholders. All right, so doesn't work well. It might work well for a Walmart, for a Campbell Soup. Firms that are established or old or kind of mature, they probably are just paying out all their free cash flow, because why reinvest in the firm? They're already doing everything they're going to do. There's nothing they really want to do. So very straightforward model, very simple model. So we'll use that on your paper, and on the exam, you'll see it as well. Now this one is just mine. So remember, on this one, when you get the paper 4, you're going to have to add a paragraph explaining the model. So make sure you got this in your notes. Let's explain it. What I like about this model is it takes the existing firm as is and values that. So it pretends like they never add any more capacity, no more stores, just what's the firm worth as is. So essentially what I say is, let's take their earnings, and let's just assume they pay all their earnings out as dividends. So they can't grow anymore because they're not reinvesting. They can't add any new stores. They can't add any new products. They can't go overseas because they don't have any money to do that with, right? They paid out all their earnings. And so they can only grow with inflation, right? Their revenues go up with inflation. Their expenses go up with inflation. So their net income will go up with inflation. Now they have some maintenance they need to do, but they also have depreciation. So they do have that expense. That's a non-cash item that provides some cash, so when they pay out their earnings, that doesn't mean they're paying out all the cash, because they do have depreciation expense. So they do have some ability to reinvest to just maintain things. And so what the model does, it looks exactly like the dividend discount model, except for instead of using dividends, we use earnings per share, but our growth rate is inflation because they can't grow any faster than that. This should give you the lowest valuation. But you're going to find out with a lot of companies, it actually gives you a higher valuation. Why is that? Probably because their dividends are much less than their free cash flow. Their dividends really don't reflect what you're trying to measure. So it may give you an indication of that. But I do think it's somewhat of a floor. I remember in 2008, Apple was trading below this number. And I remember seeing that and thinking, I probably should just put my entire net worth in the Apple stock. And I probably should have, because that was a really good time to buy Apple stock. I would be in really good shape today, or a lot better shape today. But yes, it's rare for a firm like Apple or Google to trade below this valuation. In fact, a firm like Google or Alphabet is probably trading well above what you get in this valuation. So it's not as interesting to me with the Apple or Google unless they actually trade below it. Then I'm like really interested. It's like, wow, that's freaky. But a firm like Campbell Soup or Kroger's or Walmart, yeah, that's kind of interesting to me. It's like if they just keep doing what they're doing now, the stock looks pretty cheap, looks really good. That's kind of interesting to me. It's a little similar to something we're not going to do. Sorry, I got to hit escape. We're not going to do in this class, but it's similar to something you may have heard of is Tobin's Q. Have y'all heard of that before? Anybody heard of Tobin's Q? Oops. A lady that worked for me, her name was Diane Tobin. It's like, hey, you're related to, she just married this guy named Tobin. Are you related to the Tobin Q guy? And it's like, no, pure coincidence. But Tobin Q is essentially saying, hey, I want to build this company from scratch. I want to build Costco from scratch. How much would that cost me? I have to buy all the real estate. I got to build the buildings. I got to get an infrastructure. How much would it cost me to build Costco from scratch? And someone says, oh, it's $200 billion. Well, they're currently trading for $150 billion. All right, well, something's wrong, right? And you got this building. I can buy this thing for 150. If I build it from scratch, it costs me 200. There's something wrong with this company, right? Management's really messing up. And that's what the Tobin's Q is looking at is how much it costs to build this thing versus how much is it going for? If it costs me to build it from scratch, 200 billion, and it's worth a lot more than that, then that's an insight as well. So what I'm doing with my model is I'm saying, what is the existing business worth? And if it's trading less than that and they've got new things they can do, that's probably a pretty cheap company. They can just keep doing what they're doing. They can add some new stuff. You've seen that in some places. I can't remember some of this. There's a company about just a few years ago was talking about this, but I can't remember the name of it. It might have been Uber that they were talking about, but I can't remember. But it said, if you just value this part of the business, that's what the stock's going for. And people are saying, well, what about these other things? Are they going to work out? They don't look like they have a good chance of working out. And the guy said, yeah, but it doesn't matter. If you just paid the current price, that good part of the business, that's really, really good. That's what the stock's worth. So yeah, they got 5 other things that may not work, but you're getting those for free. You're paying for this one thing, and if those other things work out, that's all gravy. That's all free. So that's kind of that approach. So let's just look at their existing. If I can get them for that, then anything new they do, that's all coming to me as extra. So that's kind of that idea here. So I view it as they value the existing business without any expansion. How much is it worth? All right. So this might give you a higher value if your firm has a $5 earnings per share, but their dividend's only 40 cents. Because that probably means there's something wrong with that dividend, not that this model's wrong, but that dividend just really is very, 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 very low. And then the H model, my favorite, I really like the H model. So the H model is the dividend discount model, but it adds on an extra growth period very, very easily. Another thing I like about it is so simple. So it is a dividend discount model. This right here is the dividend discount model, and we add this section in between, and we have another growth period we can do. And essentially what the H model says is next year you'll be at your short-term growth rate, and over H times 2. So if your H is 5, over the next 10 years, you can go from the short-term growth rate to the long-term growth rate in this kind of glide down path. That's what the H model is saying. Seems pretty logical to me. Versus, I always taught the kind of multiple growth models. where you grow for 12% for 4 years and 8% for 4 years. You know, it's kind of a stair step down. This one has a kind of gradual dropping down over time, which works pretty good. And you grow short-term can be negative. So if you got a firm that's like Exxon, say, wow, Exxon's earnings this year, this is about the best it's ever going to be. Oil prices 100 and something, whatever. I just can't see oil prices, you know, the Russia crisis is going to be resolved. And when that happens, oil prices is going to drop 30%. So I'm going to use a negative 30% growth for Exxon. Is perfectly fine. You can do that as well. That's not as frequent, but you can certainly do that. So you got to come up with a short-term growth rate. We talked about that last class, how you can do that. And then the H is that half-life. That's the hardest thing on the paper. I think probably 70% of students get 0 points for this. Fortunately, it's not a big part of paper 4. But all you got to do is some creative writing. Some students are really quite good at it. They're looking at what the firm's doing or say, hey, they got this expansion they're doing in Latin America. I think that's going to take them about 8 years to do that. And that's a big part of their growth. So I'm going to use an H of 4. That's better than nothing. So you find some way to justify it. You can't say, I think it's going to take them 10 years to get from their short-term to long-term growth rate. Therefore, I'm going to use an H of 5. That's not explaining your H because you didn't tell me how you got the 10 years. All right, so you got to explain where you got these numbers. If you're not sure, start making stuff up. Forecasting is your opinion about the future. We know we're all wrong about that anyway. So it's your best guess of how to bring that into words. But that is a tough one. Anything you can do that can quote or get somebody's insight makes it even stronger, both on the short-term growth and on the H period of time. Because it's tough. It's tough to predicting the future is tough. There's no question. Now, what we're not using, but you could use, I call it proprietary quantitative model. You want to try to use those words in an interview. It sounds a lot fancier than it is. Proprietary means what? You're the only one that knows about it. Why is that? Well, because no one else cares, and you just built the model really fast, so it's like big deal, it's proprietary. It's quantitative. What does that mean? You have at least one formula. That's not all that big of a deal. It's a model. What does that mean? It's, I don't know, you saved it in Excel somewhere. But it sounds really good. I had built this proprietary, our CFA research team used that term, and one of our judges is like, oh yeah, I really like proprietary quantity models. That sounds, it's like you didn't even see it. It could have been 2 + 2 = 4. He knows what's in the thing. But what I do on the model I have that I like to use is it's the H model. I don't know if I'll show it to you today. I might show it to you next class. We'll see. I do have students use it in my security analysis class. But it's essentially for firms like Alphabet that don't pay dividends. And so what I do is say, okay, they're not paying a dividend today. They're growing really fast today, like 20% today. And I think it's going to take them 20 years before they become a normal company. And they're just growing at 5–6%. So what I'm going to assume is they're not going to pay any dividends until they get the normal growth. Because why would you pay a dividend? If you're growing 18%, 70%, you might as well not pay a dividend and reinvest in the firm, right? You got great growth, reinvest. But in 20 years, they're going to be growing at 6%. So I'm going to have them start paying a dividend in 20 years. All right. So their dividends are 0 for 19 years. At year 20, they're going to pay a dividend. What dividend are they going to pay? Well, the typical stock in the S&P 500 pays a dividend that's 40% of their earnings. So I'll just assume in 20 years, they'll start paying out 40% of their earnings. I have their earnings growing at 20%, 19%, 18% until I get to that 20 years. And then their earnings grow at 6% and they start paying a dividend of 40%. And I just take the present value of that. It's a very simple model. It looks a lot like the H model, but you don't have to have a dividend. Y'all could all build that, right? It's not that complicated of a model to build. And it gives you decent answers, gives you decent numbers. I think that makes perfect sense for a firm like Alphabet. Alphabet's a very hard firm to value. You'd have to be pretty accurate out about 120 years to get Alphabet correct. Any of y'all feel confident in Alphabet 120 years from now? You even think they'll exist 120 years from now? Who knows? So same thing with Amazon, right? There's a good chance Amazon will be out of business in 20 years, much less 120. So who knows? But that's what we do. And with growth companies, that's the problem with growth companies. Growth companies, you don't have to be accurate the next 10 years or the next 20 years. You got to be accurate the next 100 and something years, because a lot of their valuation is 80, 90 years from now because they're growing so fast. So you're trying to get some reasonable answer out there. So maybe I'll show you that. Free cash flow models, that's what academia says you should do. If you're going in investment banking, that's what they use. You do want to expose, we're not going to do them in this class. We talk about them in my security analysis class. But the most common approach is to figure out the free cash flow of the firm. So what is a free cash flow? So the definition of free cash flow is it's the amount of cash the firm could distribute if it wanted to. And how do you distribute it? Well, they could distribute by paying dividends, buying their stock back, or paying down debt. Doesn't have to go to the stockholders, but any cash flow they have. Why is it free? It's not free because it doesn't cost anything. It costs just like any other cash flow. It's free because management has a choice. They could distribute it if they want to. Now, if you're Alphabet, you don't distribute it. Why? Because you're growing really fast and you keep it, but you could. So it's a free cash flow. You have that option. What is not a free cash flow? It's a cash flow you have no choice but to reinvest in the firm because you got to fix stuff. Walmart's got to repaint its buildings. All right. Anything that you have that's just, we call it maintenance cash flow, maintenance CapEx. That cash flow you just have to keep because you gotta keep the you're fixing your ships. If you're a cruise line, you're fixing your lines, your pipelines. If you're an energy company, that's not a free cash flow. You could not send that out to your stockholders if you wanted to because you have to reinvest it in the firm. And that's the big trick with free cash flow is how much of capital at CapEx, you know what CapEx is, right? Capital expenditures, those big projects. How much of CapEx is expansionary and how much is maintenance? If it's expansionary, that's part of free cash flow. Because management could do what? Not expand and send the money to their stockholders. So that's part of free cash flow. Maintenance CapEx is not free cash flow. You want to subtract that out. Most models for free cash flow, they take cash from operations and they subtract 100% of CapEx. That is not right. That's an error. Not all of CapEx should be subtracted. But the problem is we don't know how much of CapEx is expansionary, which we would include in free cash flow, and how much is maintenance that we would subtract out. So it's pretty tough. If you read my blog, I give you some ideas on how to separate them. I've heard some students say more and more companies are actually reporting CapEx between maintenance and expansionary. That would be really cool, right? If management would do that, there might be some subjectivity to that. So that's the reason you can't just go get a free cash flow out of a system, because most likely they're subtracting 100% of CapEx. And that's probably understating that number some. But if you got a good free cash flow number, then you value it just like we did the dividend discount model, except for you do a free cash flow that's before interest expense, and you don't use the cost of equity, you use the cost of capital for the firm. So essentially you're valuing the firm. That's the most common approach. You get the free cash flow of the firm before interest expense, you value the firm, and then you subtract the debt out, and that's how much the stock is worth. That's the most common approach. Or you can do free cash flow just the equity, so that's after interest expense. You value that using, that looks exactly like the dividend discount model, except you use free cash flow instead of dividends. And essentially that's what the dividend discount model is assuming, is that dividends equate to free cash flows, so you're getting the right answer. All right, so there's really not a big difference. So with Alphabet, they don't pay a dividend, but if you can figure out their free cash flow per share, you can use that to value the company. And just use the same models that we were using here, the H model, the dividend discount model. But read my blog if you want more information on that. Very, very important number. But I think it's really poorly defined. I know college classes, they teach it as a formula, but I just don't buy those formulas because free cash flow is not a number you just go grab somewhere. You've got to sit down and really analyze the firm and figure it out. So it's a little bit tougher. But supposedly that is the best model to use. And if you're interviewing with an investment banker, you better know those models because that's pretty common model for them to do. And they all have their own really specific definition of free cash flow. So you'd have to learn their definition. Another model that we're not going to use is called the contingent claims model. I think this is well beyond the scope of an undergraduate class. If you want to learn this more, Dr. Denver Darren in his valuation class, he covers this. So watch his class. You can get it online, email me and I'll send you his class with all my notes. Not only does he cover this in his class, but he actually provides a model where you can just plug in the numbers. So it goes beyond this class, but it's a wonderful way to think about a company. So think about this, what they mean with contingent claims model is we're going to talk about options later in this class. But we love, in finance, we always love having an option. An option just means you have the right to do something or not do something. It's all up to you, that we will usually pay money for that. So we'll talk about that with call options and put options later. We love having an option to do something. Buying real estate, right? You like having an option. So you have an house, you put $5,000 down. If you decide to buy a house, you can buy it. If you decide not to buy it, you can walk away. You put the $5,000 down, and before you can buy the house, housing prices crash. What do? Say, hey, keep my $5,000. I don't want to spend $500,000 on a $300,000 house, so you keep that's valuable to you, right? It may not be worth $5,000, but it's worth something to you. Well, what contingent claims models say is management of some firms have these tremendously valuable options. A pharmaceutical firm, they're developing a drug. They have the option of looking at the early tests, and if it doesn't look good, shutting it all down, so they stop spending money. Or the tests look good and they can expand it. That's a tremendous option, right? That's a lot of value because they can shut it down early and doesn't waste any money, or they can keep it going to make a lot of money. An energy firm, they're searching for oil. They do some tests, they discover there's not much there. What you can do, you just shut it down, you don't waste money. You find something there, you expand it. That's a tremendous option. A movie company like Disney or Paramount, they're going to do a new program. They do a few pilots. Doesn't work out very well. What do? They shut it down. They save all the money. It becomes the next Toy Story. What do? They make how many? I think I asked y'all like 4. How many sequels to Toy Story were there? 4. Did the last one still make money? Probably did all right, right? So, you look at it and you try it. And, the first Star Trek wasn't all that great of a movie, but they still made, I forget, probably made like 37 of those. I don't know what it was. They can't make too many more now because there's not too many of them left. But, you try it. If it doesn't work, you shut it down, you save money. If it works, you have this incredible upside. That's really valuable. It's hard. You can't think of that with Walmart. Right? Walmart can't do that. They don't have any options. They can build new stores or not build new stores, but they don't have that kind of thing where, hey, if this works out, we make billions. If it doesn't work out, we shut it down and we lost a few $1 million. So if you have a firm that's like that, and it really is pharmaceuticals, energy, entertainment, those places where one idea can really take them off, what that means is you do the valuation of the firm just the ways we've talked about, dividend discount model, free cash flows model. You do the value of the firm and you got a value, but you also have this option. And that option could be worth as much as the entire firm by itself. And so what you'll find is firms that have these type of options or contingent claims, they always look overvalued. They always look expensive. Why? Because the stock market gives tremendous value to that optionality. And if you don't consider this, you're never gonna buy a firm like that because they will always look expensive. Because you're valuing the firm without that option, and that option can be huge, huge. So it's a way to think about it. I don't think there's that many firms that have that type of optionality. Most retail don't. There's just not that kind of massive upside to doing something. But you want to always think about it and consider it for certain firms just to see if there might be something there. The math is ridiculously horrible. They actually use option pricing models. This doesn't sound too difficult, but the formulas aren't difficult. The difficulty is coming up with the assumptions. What's the standard deviation of the option on a new movie or on a new pharmaceutical. I mean, that's really, really hard to come up with. So they're tough from that standpoint. But if you're really interested in that, Darren actually goes through specific examples. He has a graduate level class, so it's a little bit more advanced class, or much more advanced class, because it's not only it's a graduate level, but it's graduate level of a bunch of finance majors. So it's a pretty advanced class. And then the multi-stage models, these things are, there's no reason to really use these models now that we have Excel. Excel, rather than having these multi-stage models, you just build a forecast and just change the years as you want to change them. Right? Very easy in Excel to go out 1,000 years pretty quickly. I had one professor put this on the exam and he didn't tell anybody, but I knew he was going to do it because I got him really mad. He came off of my exam because I didn't use a complete sentence. I'm like, this is a finance exam. He uses complete sentences. And he said, well, I had to because the average was too high. So I said, well, just make your exams more difficult. And oh, that made him so mad. And I knew he was going to throw something in the final because I made him so mad. So I memorized this formula. I was the only one in the whole class was really mad. I didn't tell them that it was my fault, but I knew he was going to throw this on the exam. That was a waste of brain cells for you to memorize that, other than, you know, it got me a good score on the final. There's no reason to memorize a formula like this. It's just ridiculous. So Excel has killed this. Y'all can see the H model is a lot easier than this, isn't it? I mean, this formula may not look too bad, but y'all know what that thing right there is, right? That's the sum function, which means you're going to do that a bunch of times. So this is a very complicated formula. No reason to do it. Excel does all that for you. You just lay it out. So I hope there's not a professor anywhere in the world that is requiring finance majors to memorize that formula, because that would be an incredibly ridiculous thing to do. So we're going to focus in on 3 models: the H model, the cap earnings model, which you have to explain a little bit more, and the dividend discount model. All right, those were our 3 models. So let's quickly do them because we got just enough time. We can do them. Dividend discount model, cap earnings, H model. And please don't say the cap earnings model is the cap M model. All right, I am not William Sharp. The probability of me winning a Nobel Prize in anything is less than 0%. It's actually -% probability, whatever that means. So no, it's not the CAPM model. I call it, it's my name, capital earnings model. That will mean nothing to anyone outside of UTSA or even outside of this classroom. So you do have to explain it. All right, so this one's pretty easy, dividend discount model. All right, so we gotta bring some stuff in here. So dividend 0. I think I brought that in already, but I don't remember when I put it. EPS 0. Inflation. And we need an H. And we're doing Walmart, right? So y'all remember how we got the dividends for Walmart? We may not be able to get this done today. So I need Walmart's dividends the last 12 months. So I do historical data. Well, we can keep it like it is. I just want dividends only. Apply. There's their dividends. Was that 221? 110, 221, I think, right? So 221. I need their earnings per share, EPS. So you have to pick a company. You can pick whatever company you want for 3 and 4, but you need a company that's paying dividends, or you need to come to me to get free cash flow per share. But make sure they have positive earnings. Now, one thing on the earnings, I'm using this $4.87. Remember what I did with Capital IQ? I brought in all the years. You might look at earnings per share to see if you might need to normalize it. If the current year, like with Exxon, is just really, really high because they had a really good year, you might look at the median or the average over a few years. I'm just going to go ahead and use the 487 for Walmart. I'll stick with 2% here. And what did I say with Walmart? 7.5% short-term growth. I was making it curbside, online, maybe some overseas kind of stuff. I don't think Walmart is a high growth company with a lot of years ahead of it for high growth. I just think, I mean, they're just fairly saturated. They haven't been too successful in India. They haven't been successful at all in other places outside of Latin America. I just don't think they have much ahead of them. One thing I will say on the H is 5 is a very big number for high growth. All right. Very few firms can sustain really high growth because 5 on the H means 10 for the growth, right? So for Walmart, I'm going to use 2. It's kind of, I think curbside does have some play to go. Home delivery has some place to go. I do think they have some option to picking up business from other small retailers and Kroger's and those kind of things. So I think there's something there for them, and they are very impressive. Maybe it's kind of sad in Latin America because they are putting a lot of businesses out of business in those countries because they are a very tough competitor. They do better in Latin America than they do in New York City. We'll see if they open up a store in New York City, that would be fairly. Why does New York City okay with Target, but they hate Walmart? That seems kind of strange, doesn't it? Does that make a lot of sense? But anyway, so we'll do the dividend discount model. So you take dividend 0 times 1 plus long-term growth divided by your KE minus long-term growth. And we get a number I can't find. 209.90. You're trading for 154.99. Does that sound like a buy, sell, hold recommendation so far? Sounds like a buy to me. That looks like, what, a good 33% upside. The H model. On the H model, I can copy down the dividend discount model because it's the exact same model. And all I got to do is add dividend 0 times H times short-term growth minus long-term growth. Everything else is the same. A little bit higher. Why not a whole lot higher? Well, because I only have 2 on the H, and the 7.5 versus the 4 is not that big of a deal. In cap earnings, EPS 0 times 1 plus inflation divided by KE minus inflation. And there I got a lower number. You expect a lower number, even though there's sometimes you won't get a lower number. But what's exciting about this number? It's higher than the current price. So that means if Walmart can just maintain what they're doing, this looks like a pretty good buy. All right. So what I'll show you next time is the football chart and some other things, but we'll keep working with this. And then I'll show y'all this weekend. I know you'll finish paper 2, so I'll send you the videos so you can start working on 3 and 4 because there's a video walks you through that.